Okay, let's just jump right in. Right now, literally as we kick off this explainer, algorithms are out there executing millions of trades before you or I can even finish blinking. We hear about AI all the time, right? People talk about it like it's just this hot new trend or some shiny new tech sector to throw money at. But the reality, it's actually way more profound than that. What we are witnessing right now is a fundamental operating system upgrade for the entire financial world. It is completely rewiring how the market processes information, how it organizes capital, and ultimately how it defines value.
So you really have to stop and ask yourself, what actually happens when machines, not humans, become the primary actors in the market? And what's so fascinating about this question is that it totally shifts our focus. We kind of have to stop obsessing over simply buying AI stocks, you know? Instead, we need to understand how the actual physical mechanics of trading and market infrastructure are transforming right before our eyes. I mean, when the main entity reading the data, making the tough calls, and executing the trades is an algorithm, the rules of the whole game just fundamentally change.
To wrap our heads around this, we need a totally new framing. Think about it like this. Just as basic reading and writing were the absolute baseline skills you needed to enter the modern economy over the last century, AI is becoming our new baseline literacy. It's this new foundational cognitive ability for organizations, markets, and individuals to even function. The massive advantage now goes to whoever can use AI the fastest to read the world, write actionable instructions, and build these continuous feedback loops.
So to break down this massive global shift without getting totally overwhelmed, we're going to dismantle how this new financial machine works across 5 parts: rethinking market information, redefining asset moats, the AI capital cycle, markets built for machines, and finally, human value in AI.
All right, diving into part 1, rethinking market information, and how we are rewriting what actually counts as tradable data.
Think about the sheer contrast here. We're moving away from a world where human beings sit around reading highly structured, neatly packaged data, quarterly earnings reports, official macro releases, standardized analyst notes. We're leaving that behind for a world where AI algorithms are constantly reading and pricing the totally unstructured data of the entire planet. Today, a sudden spike in GitHub code commits, a weird shift in the language used in a company's job postings, real-time satellite images of supply chains, or even just the frustrated tone of customer service logs. All of that can be instantly digested as tradable financial information. The market isn't just reading the Wall Street Journal anymore, guys. It is reading the world.
Just compare a human trader squinting at a TV trying to decode if Jerome Powell looks a little stressed at a press conference with an AI-driven quant system. Take a firm like XDX Markets. They aren't just listening to speeches, they're using massive, incredibly powerful data centers out in places like freezing cold Finland to instantly process deep learning signals. They've essentially turned industrial-scale computational power into continuous money-printing price forecasts. It's wild.
But here's the catch, and this is absolutely crucial. While machines process all this data at warp speed, it introduces a totally new, massive vulnerability. If everyone on the market starts plugging into similar data feeds, using the exact same deep learning models, and writing similar prompts, well, it creates this structural risk of synchronized, market-wide misreading. Sure, the AI cranks up efficiency, but it also engineers these highly crowded trades where algorithms can collectively buy into the exact same wrong narrative at the exact same millisecond.
Which brings us to part 2, redefining asset moats, and specifically, the software meltdown.
So, for years, software companies just sat back and enjoyed incredible valuations because of their legacy moats. You sold a seat license, you locked a user into your specific workflow, and the cost of retraining staff to use something else was just way too high. People stayed put. But the AI agent threat, it completely shatters that. If an AI agent can just seamlessly jump across 10 different applications to complete a task on its own, that traditional stickiness of buying individual software seats just evaporates. Instead of paying for 20 Salesforce licenses so your team can manually click buttons, you just pay the AI agent to finalize the contract. You stop paying for a shiny software interface, and you start paying purely for task completion.
And we really saw this play out in what got dubbed Software-mageddon back in February 2026. The trigger for that massive sell-off was the launch of autonomous agent tools like Anthropic's Claude Cowork. It caused this sudden, brutal, systemic repricing. Investors woke up and realized, wait a minute, those stable, predictable software cash flows we love so much, they're actually at huge risk of just being technologically substituted.
And the fallout from that repricing? Try $1 trillion. A trillion, with a T. That much value just evaporated from software market caps in the span of 12 months.
Heavy hitters like ServiceNow, HubSpot, Salesforce, they all saw massive double-digit declines year to date. The market was aggressively recalculating their future earnings, assuming those legacy moats were totally gone.
But the pain definitely isn't contained to Silicon Valley. The market is objectively downgrading human middlemen everywhere. Just look at these single-day drops from early 2026. Legal data giant Thomson Reuters tanked 17% in a single day. Wealth management powerhouse Charles Schwab dropped 8% just because some new AI tax tools were announced. Insurance broker Willis Towers Watson down 12%. Basically, any industry relying on document review, matching risk, or managing processes is seeing their core fees getting completely attacked by AI.
All right, moving on to part 3, the AI capital cycle. Heavy industry, heavy debt. Take a second and look at this staggering number. $740 billion. That is the estimated AI capital expenditure by the major tech hyperscalers for 2026 alone. That's a 64% jump from the previous year. And this money isn't just disappearing into the cloud, it's funding physical, concrete things. Data centers, tens of thousands of GPUs, insane cooling systems, and the massive power grids required to keep these models running. We are talking about heavy industry on absolute steroids.
But here's the issue. Because this unbelievable infrastructure spend is happening right now, today, but the actual revenue payoff is years down the road, we are seeing severe, critical strain building up in the financial plumbing. It's essentially a downstream debt tsunami. Private credit funds are being forced into markdowns. Distressed software loans, they surged from $7.7 billion to $25 billion in just 6 months. Business development companies, the folks lending to Middle America, are dropping. And the exit markets for IPOs and M&A are just heavily delayed. The whole capital cycle is stretched to the absolute limit.
Which leads right into part 4, markets built for machines, the 24/7 API.
We are right in the middle of shifting from a financial system built around human limitations, markets that lazily open at 9:30 a.m., close up at 4 p.m., take days to settle trades, and require people pushing paperwork for compliance. We're moving from that to a pure machine market. This new architecture demands 24/7 uptime. It needs continuous digital handshakes, APIs, and fully automated compliance using tokenized securities, which are basically instantaneous digital deeds. Wall Street is literally out there rewiring its roads and traffic lights because the new drivers on the street, they don't sleep, and they trade fractional assets across global time zones instantly. And finally, part 5, human value in AI, redefining financial talent.
Okay, time for a harsh reality check. The phrase "I can calculate" is officially dead as a professional moat. It's gone. If your main value at work is gathering up data, running basic spreadsheet formulas, writing routine weekly reports, or just executing standard step-by-step procedures, I hate to say it, but that labor is rapidly becoming a commoditized baseline function. It's no longer this premium skill that commands a high salary, and we all really need to wake up and pay attention to that shift.
So naturally, you're probably asking, where's the value then? Well, the true human premium is going to lie in higher-order thinking. It's about complex problem definition, actually knowing what brilliant question to ask the AI in the first place. It's deep institutional understanding. It's causal judgment and reasoning. In the finance world, it's about understanding how a shock in one specific asset class transmits to another in weird ways that historical data might totally miss. But above all else, the absolute most premium skill you can have, knowing exactly when not to trust the machine's output.
I absolutely love this quote because it perfectly captures the core takeaway of this entire explainer. You really don't need to fear the technology, but you absolutely positively must evolve your skills beyond just mechanical execution. AI is fully here to do the financial labor, right? But it desperately, desperately needs the financial judgment that only a human being can provide.
So as Wall Street finishes up this massive operating system upgrade, and as AI just continues to totally reshape the boundaries of information, assets, and capital, I want to leave you with one final thought to chew on. If the future of work truly means that everyone, including you, is going to be equipped with their very own custom AI agent, how are you going to use yours to redefine your value? Thanks so much for joining me on this explainer, and keep questioning the mechanics of the world around you.